Good afternoon, everybody, and welcome to this edition of our weekly Broker Moves Review for the week ending 23rd of April. Apologies for the belated nature of this edition. I couldn't quite get it out on Friday afternoon, so obviously we're going today. The Think Markets difference before we get started is substantial. $8 flat rate trades, your own holder identification number, unlimited phone support, and no hidden platform or subscription fees. 5 fantastic reasons to make sure your next ASX share trade is with Think Markets, and I'll give you 5 more if you're looking to join the Think Markets family before June 30. New clients getting 5 free trades. As is usually the issue with these things, there's a few terms and conditions, so check the website for further details. The agenda for today is to check out all of the big broker moves on all of the Aussie stocks for the last week. So that's upgrades, downgrades, price target changes, and the rationales why they did what they did. And then we'll have a look at some stocks of interest a little later on. We'll kick off with the ratings, upgrades and downgrades first. Upgrades on screen, and don't forget that each broker has a system for letting clients know what they should do with a particular company. So it could be buy, hold or sell. Sometimes there's some funny ones in between and outside thereof. For example, underweights, underperforms, accumulates, equal weights and the like. They'll also have a price target based upon their valuation, and they're usually looking sort of 12 to 18 months ahead. Morgan Stanley increased their rating on Bank of Queensland from equal weight to overweight. They also increased their price target from $9.60 to $10. Now that's a change of 4.2% to the upside, and it leaves about 9.6% between the current price of the share and the target price specified by the broker. Bank of Queensland reported their half-yearly profits the week before, and Morgan Stanley simply responding to that. Morgan Stanley also on Dexus, upgrading from underweight to overweight. It's quite unusual for a broker to go 2 steps in an upgrade, so there's usually an equal weight in between those two. A rather large increase in the price target there from $8.25 to $11.70. That's nearly 42%, and the broker is still seeing close to 17% upside in the business. Morgan Stanley believes fears around the future of office, which is basically what Dexus does, are overdone, and that we're on the verge of a major uptick in the sector. On Galaxy Resources, Credit Suisse went from underperform to neutral, increased their price target by 78.6%, which means the stock is about fully valued. As far as they're concerned, I would say they are playing catch up to the rather stellar performance of Galaxy. And Orocobre, another lithium stock, and those stocks announced a merger of equals during the week, so you'll see them feature quite prominently in today's presentation. Downgrades, not so lucky there. We can see Amcor going from outperform to neutral, price target decrease, as was Australian Pharmaceutical Industries at Citigroup from buy to neutral, 10% decline in the price target there. The company announced its half-yearly results, and those results were punctuated by a 2.6% decline in total revenue, and EBITDA fell 26.5%, hence the negative response from Citigroup. Lumina, now Macquarie Bank reviewed their quarterly trading update and noted some rising costs, which caused them to downgrade the stock to underperform from neutral and also decrease their price target. And Macquarie is still thinking, even with that decreased price target, that the stock is overvalued by about 12%. On Challenger, they had some earnings news out during the week, so they reported that net profit after tax was only expected to be at the bottom end of the $390 million to $440 million guidance range that they had previously provided, and that change reflects a wrong bet on some credit spreads. Basically, they had invested in certain products. They thought those products were going to be at a certain price. They weren't, and they weren't able to pass that price increase that they face on to consumers. They'd be looking to rectify the problem, but it will not prevent an impact on their financials going forward. Challenger is one of our stocks of interest, so we might pause there and have a closer look at it a little later on. Credit Suisse from outperform to neutral, a 9% decrease in the price target, but still seeing close to 20% upside in the stock. Main Pharma, Macquarie downgrading there, but increasing the price target. They still think the stock is overvalued. However, operation issues blamed for that mainly, and Morgan Stanley potentially preferring Dexus to Aircentre there, which got a downgrade and a price target decrease also. Having a look at the price target increases, so no change in the rating here. APE, ticker code Ecozone Automotive, stands out the most. 4 out of 4 price target increases of varying degrees, anywhere between sort of 6% there at Morgan Stanley, up to Credit Suisse about 21%, but having a look at the price to target, not so fantastic. They're a little mixed, with only Morgan Stanley seeing some upside at the current price, and neutral, accumulate, overweight, and buy. At least the ratings are still quite positive towards the stock, although you have to question some of those ratings given their price to target. Very interesting. But the company did come out with a trading update noting that they made about $105 million in net profit over the quarter. Those are unaudited numbers, but when you compare that to the FY20 net profit after tax of about $147 million, you can see they are tracking along at a much, much higher run rate than last year, so hence the upgrades in price targets there. Afterpay was very interesting, but a small price target increase there from Citigroup to 128.30. Stocks roughly fully valued, hence the neutral rating. We've talked about Alumina down the list of Bapcor. They reported a 4.1% increase in their first half profits on a 3.2% increase in revenues. They also increased their interim dividend to 7.5 cents, that is fully franked. But the market didn't like its forecast increase of 9% for full year net profit, because that was at the lower end of previous guidance. And whilst we did have 3 price target increases here, they're very modest. The stock did fall during the week. Still some upside though seen from the 3 brokers surveyed, and they're still maintaining their positive outlook on the stock with buy, outperform and outperform. BlueScope Steel, price targets going up again on some very, very strong steel prices. Into the next page now, we've talked already about Galaxy Resources and their merger of equals with Orocobre, so they've each got some price target increases there, but in both cases the stocks are considered to be fully valued for the most part, and ratings around that sort of neutral area. Oz Minerals doing very well as commodity prices continue to rise. A nice pop-up also there for another lithium stock, Pilbara Minerals, going up 15.4% at Macquarie Bank, and still some 31% of upside expected there, and an outperform rating. That's quite interesting. Rio Tinto getting a nice little pop-up there from JP Morgan, who retained their buy rating, and they also see quite a good deal of upside there with about 32.9% left in that stock. Into the next page, there's quite a theme developing here, isn't it? So Sims is a scrap metal recycler, but again in that sort of metals commodity space, and 6 out of 6 price target upgrades here, and quite significant upgrades as well. And Sims provided the market with a trading update. They said that they expect FY21 underlying EBIT to be between 260 and 310 million, compared to their loss last year of some 57.9 million. They also announced that they'll be paying back $7.5 million in their JobKeeper payments, so a vote of confidence from management. Stockland getting 3 there, also providing a trading update to markets, but no big deal. Santos got a couple of price target increases, but as we'll see in a couple of slides' time, a few decreases as well. These were small ones here. They provided their operational and financial update for the quarter ending 31st of March. Production was down 2% from the previous quarter thanks to lower gas demand in WA and unplanned maintenance in Papua New Guinea. The first quarter revenue was up 5% though on the previous quarter, and about 9% from the corresponding quarter in 2020. Prices were up for natural gas by about 15%, and that was obviously the contributing factor there to the higher revenues. But market generally disappointed there with the lower than expected production. On 7 Group holdings, we saw some small price target increases, but once again market response was mixed, because there was also a decrease, as we'll see in a couple of slides' time. Now 7 Group holdings here, just checking my notes, they announced a capital raising, actually $500 million in new equity to provide quote-unquote balance sheet flexibility and to reduce debt, but the company did reiterate their FY21 guidance. Heading into the final slide here, Western Areas told the market that they had seen a 20% increase in nickel production, but lower shipments. Costs were on the increase, but their Odysseus development, which is the key to replacing the Forrestania mine, which is ending its near the end of its mine life, is on track for production in FY23. Brokers generally positive on it, not by a huge amount, but still plenty of upside seen by JP Morgan and Macquarie, with buy, outperform and overweight showing that brokers are quite positive on the stock. Looking at the price target decreases, we've talked about many of those. AMP in the news later in the week as they announced a demerger of their capital markets business, but also a quarterly report which was a little bit worse than expected, hence some of these large price target decreases here. We'll probably see more on that in the next update as brokers respond to the demerger plan. We've talked about API, we've talked about Challenger, but we can certainly see brokers responding to what is a pretty clear profit downgrade there on the back of basically management mistakes. Still quite a bit of upside seen in the share price though, but fairly neutral here on the ratings with just the one buy there from UBS. Into the next page there, Origin Energy still getting some negative responses to its profit downgrade. The week before, Nuix got quite a large price target decrease from Morgan Stanley. That was on the back of management lowering their FY21 revenue guidance by about 4 to 7%, depending on estimates. And they said that growth would only be around about 5%, which is well below their recent growth of over 20%. Morgan Stanley retained their overweight rating though, and despite the price target decrease, are still seeing over 62% upside in the price from here. Down the list, we've talked about Santos and its quarterly production result. Woodside also on this list, unfortunately for very similar reasons. They reported better than expected revenue, but lower than expected production. And that saw some very small tweaks in the share price. But I wouldn't get too concerned because the brokers are still seeing plenty of upside here. And with buy, outperform and buy, 3 out of 4 of them are still happy to do more than just sit on the stock. Okay, stocks of interest today. We've covered many of the reasons why these stocks are in the news. APE on its March quarterly update. Just having a look at the chart here, some of the fundamentals and some of the comments from the brokers. I did use this chart during the week in an AusBiz interview where I talked about what you want to see for a price action turnaround. So we're not really interested in what's going on here. This is more providing a template for what you want to look at probably until around here, because prior to this, the stock was in a rather sharp downtrend, bottomed out around 250, and you can see now it's over $17. So how do we sort of pick these turnarounds as they begin to develop? We'll never be able to pick the exact bottom using a technical method. You'd need a crystal ball for that, but what are the signs in the technicals to say that maybe we're turning around? So maybe we can get in around here, sort of around that sort of $6 mark. Okay, so first of all, you would be seeing in a downtrend predominantly black candles, so some white candles finally would be nice. You would have been seeing lots of lower peaks and lower troughs. Okay, so we'd like to see higher peaks and higher troughs. You would also see a short-term downtrend on the moving averages. We'd like to see that change. Okay, so when we get to that sort of $6 mark, we've changed to some pretty nice candles, high peaks and high troughs, and a short-term trend change. If you're a more aggressive trader, that's where you could be looking to enter. I like to see, in addition to the factors we've already discussed, the long-term resistance zone from the longer-term moving averages stop being resistance and start to act as support. So really, here is the key level for me. That's where I'm happy to get in. Now, it's certainly not 250, probably looking more like sort of 830, give or take, but that for me is the place to go. If you're even more conservative, you might also wait for the long-term trend to change, but as the name suggests, it's a long-term trend. It might take a long time to change. So I'm happy to get in if the long-term trend hasn't changed, as long as I've seen all of those other factors, and then obviously you're trying to ride the trend as long as possible from there. A little bit of a TA lesson. Back to the fundamentals here, and Credit Suisse noted in retaining their neutral rating, but increasing the price target substantially from 13 to 15.70, that they were quite impressed with the first quarter trading update. They said, however, we don't really want to extrapolate that success out too far because it's probably more to do with the pandemic and the impact on supply. And I should also add at this point that the company is in the business of selling both new and used cars and support services for those. So obviously when COVID hit, it was harder to get new cars in, and that meant that dealers had substantial flexibility with their margins for their sales. So that certainly helped them along. JP Morgan also raised the price target quite substantially, retained an accumulate rating. They said that the recent sales bump and margin boon was mainly due to those supply constraints, but those constraints could persist into the rest of calendar year 2021. They were impressed with the cost out program, which was on track. Morgan Stanley increased their price target by $1, retained their overweight rating. They said the first quarter trading performance was well ahead of their expectations, but would refrain from extrapolating, much like Credit Suisse, those almost perfect trading conditions out too far into the future, but the long-term prospects remain solid, hence the rating. UBS raised their price target from $15 to $16.45, retained their buy. They were pleased with the first quarter trading update, but were cautious with respect, again, to extrapolating the stellar performance out. Still, seasonally, the second quarter is very strong anyway. So, obviously, we've just had a strong March quarter. We could see a very strong half-year end and then some very strong full-year results. More broadly speaking, brokers are at an average recommendation of a buy, with one strong buy, 6 buys, 3 holds, and just the 1 sell at this point in time. Their mean target will go up as a result of those changes. This data provider takes a few days to update, so it's going to be closer to probably where it is, around that sort of 17 or 18 level. Looking at the company's fundamentals, that is a very strong number there, enterprise value to revenue, so very happy with that. The PE, I wouldn't say is crazy expensive for the growth that is in the business, which is not bad at all at 1.08 on the PEG. Dividend yield is quite solid at 3%, and it is fully franked. Price to cash flow is very, very sound, and the return on equity is excellent. So I'd happily give that an A grade. This is obviously a big tick here, and the chart looks fantastic. So with tick, 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 I'd be happy to continue to buy Ecozone Automotive, or if you had it, then I'm certainly a holder. This is one we have had a buy on in the fairly recent past. I haven't covered it for some time. It was, look, I reckon we probably put a buy on it here on the basis of everything I talked about in that turnaround play. And look, unfortunately, we haven't covered it since. It's probably a good time to do it now. And I am seeing some concerning signs coming in now in the technicals. So if you did buy it on that recommendation, I think I'm going to swing to a sell on this one and just being out of the stock just for safety, because with these strong black candles coming in and this change in the price action, I think the risks are too high to remain a holder. I'll let you press pause and read some of the comments there, but we did see earlier on that there were a number of price target decreases and just the one increase on the stock. We talked about management's mistake in some of the pricing for their products, and that impacted on margins, and they were trying to rectify that going forward, but brokers generally don't like management ineptitude, and we can see the share price being punished accordingly. Overall, however, we're still at an average of a buy with 2 strong buys, 3 buys, and 8 holds. Interestingly, no sells, strong sells. So that's encouraging if you're still going to keep the faith and hold on. The mean target will have to come down and leaves probably a little bit of upside in it from here, maybe indicating the stock is a little oversold. Having a look at the fundamental numbers here, that one is no big deal. This one is certainly reasonable, but because they did experience a loss last year, we can't find a PEG, or maybe the data provider's just not supplying one. It does look like there is some growth in the business going up because that PE is expected to fall. Dividend yield is quite positive, actually, with around about 4% expected for this financial year, and then 4.5% for the next financial year. Price to cash flow is actually very good. I'm happy with that. Return on equity is not bad. Look, I'm probably going to give this a B rating there. That's probably a tick, but let's see how they go. There may be some downgrades not too far away, especially if the share price doesn't bounce quickly, and that, unfortunately, is a big question mark for me. So, look, I think there's just enough doubt there to get to the sidelines and maybe try and find something better. Having a look at the next one, Sims Group. Now, this is a company going very, very well at the moment. So commodity prices on a tear at the moment, and these guys recycle scrap metal. So higher prices, very good for their bottom line. Credit Suisse raised the price target from 15 to 17, only at neutral though. We did discuss the update they provided to the market a little earlier on, a profit guidance upgrade, and they were going to pay back their JobKeeper payments. In response to that, we did see 6 out of 6 of the brokers surveyed increase their price targets. You can press pause and see by how much. But just some of the comments here. Citigroup noting the company is performing well with respect to both costs and volumes. Higher scrap prices are boosting margins, and they increased their FY21 earnings before interest and tax number by 76%. That's massive. And for FY22 by some 22%. Credit Suisse retained their neutral rating and after reviewing the operating update, noted that short-term tailwinds from high scrap pricing will bolster FY21 earnings. They are reluctant to extrapolate this out to longer term, though. They like the better-than-expected cost savings and margins. JP Morgan retained their hold. The broker anticipates robust trading conditions likely to extend into FY22 and increase their profit guidance. Scrap prices to remain at elevated levels as China imports increase. They do think the shares are fully valued, though. Macquarie retained an outperform rating. They were impressed with the trading update and improved profit outlook, sees risk-reward as favourable. Morgan Stanley retained an equal weight. They said that the profit guidance, revised to the upside, as significantly ahead of their expectations. They like the volume growth, margins and strong balance sheet. UBS, they retained their buy rating. They were pleased with the trading update and improved guidance. Better than expected. H1 margins to continue to improve, and they increased their FY21, FY22 and FY23 earnings estimates by as much as 54%. So all very positive there, but the broker's not prepared really to go all out on this one. We do have 3 buys, 5 holds, but there are a couple of doubters in there with a sell and a strong sell. The mean target of $16 will go up, probably closer to about 17 or 17.50, which does provide some limited upside there. In terms of the fundamental numbers, that number is outstanding. Very happy with that. PE, I wouldn't say is expensive given there is some fantastic growth in the system there. The dividend yield is modest but not insignificant. Price to free cash flow is excellent. Return on equity is the only thing which is disappointing there, but it's not surprising given the capital intensive nature of this particular business, but certainly enough to give this one a very solid B+, in my opinion. This is a little bit of a question mark, but the stock is certainly a double tick here because it looks fantastic. Bottom left, top right, fantastic short-term and long-term trends. Candles are predominantly white. Yes, there's a little bit of supply coming in after that update, but I'd be happy to continue to buy this on any pullbacks, which I think you probably will get in the near term, and therefore continue to ride this one higher. The last stock we'll talk about today is Woodside Petroleum, certainly a widely held. Now, they had their quarterly production update out. JP Morgan retained their buy rating. They said that the production numbers were sound, with sales prices and revenue ahead of expectations, but they were concerned about cost pressures, but remained optimistic on the production and price environment, and those higher energy prices de-risk the business. Macquarie retained their outperform rating. They said that the quarterly update was roughly in line with expectations. They do like the growth prospects going forward, but wish to see further progress on divesting non-core assets. Morgan Stanley retained their equal weight rating. They said cost increases were a concern, and that's a reason for them making the small downward adjustment to their target price. UBS retained their buy rating. They said they were impressed with the quarterly revenue and more broadly operational performance. They said the market is undervaluing the shares based upon the current crude pricing, and that a new CEO would de-risk the opportunity in Woodside further. Overall, the brokers are quite positive. 2 strong buys, 7 buys, 4 holds, and just the 1 sell. Mean price target here will probably drop slightly to about 27-ish. But still allowing for quite a bit of upside. Having a look at some of the numbers here, this is not bad at all. The PE is good, considering that there is going to be some growth coming into the business. The dividend yield is excellent at close to 5%, and the return on equity is not great, not bad either, but considering this is also a very capital intensive business, so probably a very solid B on that one. This is a tick here. The chart for me is looking a little bit shaky. I don't think all is lost. I think as long as it sort of holds above that level there, I think we're okay. It is one we did put a buy on sort of early 2021. I'm quite confident it was around there, and based upon those turnaround factors that we discussed earlier. Much like Challenger though, it is getting harder to keep the faith. So this one is certainly on watch. I'm more neutral on at this stage because of those technicals. The candles here are somewhat encouraging, but I do want to see it turn back up fairly shortly. Okay, well that's it for today. You can catch all of our other market news updates at the market news section of the website. You can follow me or the Think Market handles on Twitter if you like, and we do have some webinars this week that you must register for in the webinars section of the website. Ask the Experts, where you get to bring your portfolio to the table this Wednesday, and then a fundamental analysis refresher where you can learn how to make sense of all of those fundamentals that I just talked about, and then we'll continue our top 3 series with top 3 stocks under 30 cents. The disclaimer before I leave you today says that everything we just discussed is general in nature. We do have some products at Think Markets that could see you lose more than your deposit, so please read this disclaimer carefully, or if you have any problems at all, give us a call. It's been a pleasure chatting with you this afternoon. All the best for your trading. Until we catch up again, bye-bye for now.